Recording in progress.
Yeah. I will do question 1C, which is fixed assets. It's for 20 marks, and you're supposed to complete it within 12 minutes. I highlighted it in the previous video. We have information relating to Patel's pies, extracted balances on 1 October 2021, equipment. That should be a cost price because we gave an accumulated depreciation on equipment below it, right below it. And we have equipment. The cost price will be 1,740,000 and accumulated depreciation on that equipment will be 651,000. Now, I'm going to go and look at my answer book and check if indeed those are my opening balances. All right. Because I haven't read much, so you'll notice that, yep, they are there. Those are opening balances. So that 1 million, it is the cost price, it's not the carrying value. And accumulated depreciation will be 651,000. Now, you know from historical cost method that equipment or all your assets are recognized at cost price. This is for grade 12 purposes, right? And lower grades, obviously. There's one question, I think it was last year's exam, November IEB exam, where they told you that we used stock for demonstration purposes. But then, because we used it for demonstration purposes, we had to sell it at a lower price. So that stock was devalued. You will learn this when you get to varsity, that stock is valued at the higher of at net realizable value. Basically, your net realizable value is the higher of value in use and selling price minus cost, if I'm not mistaken. Okay. The expected selling price minus the cost. I don't remember. I did this like a while back, about 10 years back. Um, yeah. Yeah. But that is not important right now, obviously. What we know for sure is that your assets should be measured at cost price. Okay. It should be measured at cost price, right? And the cost price of all equipment at the beginning of the year is 1,740,000. Accumulated depreciation on equipment is 651,000. Now, the first one, they say the following transactions relate to the equipment for the year ended 30 September 2022. I kept quiet there a bit because, yeah, my train of thoughts is all over. That accumulated depreciation, what is accumulated depreciation? Know that accumulated depreciation is the depreciation of all this equipment. We have different types of equipment. We don't just have this oven, okay? We might have furniture, we might have desks, we might have desktop, we might have laptops, all of those. When you depreciate all of them, the accumulated depreciation at the beginning of the year will be that 651,000. That 651,000 represents the added depreciation of all the equipment we've got from when they were purchased up to when we stop using them. So when we stop using that equipment, it should be deducted from the cost price. The cost price of that equipment should be deducted from the cost price, and accumulated depreciation of that equipment should be deducted from the total accumulated depreciation. Now, here's the thing. People, when you look at equipment, because they wrote equipment, you think it's one equipment. No, guys, it's multiple equipment that are added together. Their cost price added together will be that 1,740,000. Their accumulated depreciations added together will be that 651,000. You got it. Good. Now, A says, on the 31st of January 2022, an oven that cost 460,000 caught fire and was destroyed. It was scrapped, basically. It's gone. We don't have it anymore. So we need to stop depreciating because we can't use it. Guys, remember, depreciation. That's why I always emphasize definitions with my kids. Depreciation is the cost of using an asset. as you use the asset, that usage part of the asset is converted into an expense, which we call depreciation. Matching principle says that you see that part that you use it to generate income. That's why you match it against, that's why you need to recognize depreciation, which is a non-cash item, by the way. So there's no money that goes out to pay for depreciation. It just devalues your asset. And all these devalued amounts, we add them together, we put them under one account, which is a garbage, rubbish account, and that is called accumulated depreciation. I know some teachers say that it's a negative asset, even though I'm against that, but I think that one works better because immediately when I say it's a valuation allowance, kids get lost, because I always say if it's a negative asset, then what is provision for doubtful debts or provision for bad debts? It's also negative assets. I guess it works better for students, but accumulated depreciation, it's simply all your depreciation, all these losses of the asset, you keep on accumulating. To accumulate means to add. You keep on adding them together and you put it into this bin we call account, this bin we call accumulated depreciation account. So I depreciate from when I bought it, I put it into that bin. Accumulate for next year, I put it into that bin. Accumulate, I depreciate again the following year, I put it into that bin. All this rubbish goes into this bin, and that bin, we call it accumulated depreciation, which increases on the credit side. It simply it's helping us to devalue an asset and for us to determine how much garbage have we accumulated from this asset, how much have we devalued, how much of this asset how much of this asset's value have we used already. That's what it's telling us. Carrying value is the value that you still have on that asset that you can still use to generate more money for the business, which takes you back to what an asset is. It's a resource we use to generate revenues or any source of income for the business, cash or its equivalents. Or they normally refer to it as an economic value. You got it. So the definitions are key. So this asset here, the cost price of this oven that was destroyed is 460,000. Accumulated depreciation of that oven on the 1st of October 2021 is 138,000. Note that 138,000 is included here. I normally hear my kids say we are within. It's within there. It's within. It's inside. We need to take it out there. It's in there. Okay. It's already included in that 651,000 because we didn't know that it was going to get destroyed 4 months after the beginning of the financial year. Is it 4 months? It's October, November, December, January. It's 4 months. Okay. And then they said, I'm going to pass on that. Okay. Note that 460, it's also within that 1,740,000. It is in there. It's included in there. We'll get to it later on. Then they say in B, the oven was replaced on the 1st of February with a new one that was purchased on account. So we purchased a new oven. Ah, come on now. Will that new oven have accumulated depreciation? No, 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 no. It can't have accumulated depreciation. How can we say it has accumulated depreciation when we even haven't started depreciating it yet? Depreciation is calculated at the end of the year, but you consider things that happened during the year. The last thing in C, they gave us the depreciation is calculated at 18% using the diminishing balance method. Key, right? The one that Future is looking for. Now, let me move on. I'm going to come here. And the first thing I always tell my students is that draw the timeline, draw the timeline, draw the timeline. But I'm not saying you must waste time. Draw the timeline to save time. Now, I've seen some of my students, they normally write all the months. Like, no, write key dates, like the beginning of the financial year and the end of the financial year. And when something major happened, Something major happened, which happened on the 31st of January. We lost an oven and we only used it for 4 months. Now, that is a game changer because it means that I can't just calculate depreciation the normal way. They said diminishing. I can't take that 1,740,000 minus that 651,000, get the carrying value and take the carrying value multiplied by the depreciation rate. I can't do that because of this asset here. This asset, I need to do it separately. I need to split it from all the other assets. Okay. So for this asset specifically, I will need to calculate carrying value at the beginning of the year. Irrespective of the depreciation method that you're using, whether it's straight line or diminishing, or there's a new one that's coming up next year, which you call it production units, it doesn't matter. You calculate carrying value at the beginning of the year because you don't want your current year depreciation to exceed the carrying value at the beginning of the year. Oh, that'll be classic though. Imagine putting this and saying that it was destroyed on the 31st of Jan, but at the same time, when you calculate depreciation for that month, it exceeds depreciation, like it exceeds carrying value at the beginning of the year. So you still have to calculate depreciation for 4 months and then limit it to 1 minus the carrying value at the beginning of the year. Oh, that would be classic. But I can't ask that in grade 12, can I? I don't think I can. All right. We're not there yet. So what you need to do here is to calculate the carrying value of this asset that was destroyed. I already put the answers for you there. So carrying value at the beginning of the year will be 460,000 minus 138,000. So it's cost at the beginning of the year minus accumulated depreciation at the beginning of the year of that asset, which gave us 322,000. Then you take that 322,000, you depreciate it. I was going to take 460 if it was depreciated on cost price, but here is depreciated on diminishing balance. So I have to use the carrying value, i.e. the book value. It has so many AKAs. Hey, is the book value, is the carrying value? What's the other one? Obviously, it's a diminished balance, right? That's what we're going to have. We're going to take that 322,000 and multiply by 18%, but we've only used this asset in the current year for 4 months. Yes, we're calculating everything at the end of the year, but everything was done in your asset register, but we only use it for 4 months in the current financial year. And it'll give us that 19,320. That is the depreciation for 4 months. Now, here's the thing. On the 31st of October, on the 1st of October 2021, what was the accumulated depreciation of this oven that was destroyed? It is that 138,000. But we use it for 4 months. So on the 31st of January, will accumulated depreciation still be 138,000? No. The accumulated depreciation has gone up. Accumulated depreciation is only increased by depreciation. You dump into this bin. You dump depreciation into this bin, which is accumulated depreciation. Did we use this oven that was destroyed? Yes. For how long? For 4 months. And what is proof that we used it? We've got that 19,320. Take it and dump it into the accumulated depreciation account of this asset. So on the 31st of January 2022, what will be the accumulated depreciation of this oven that was destroyed? It will be 138,000 plus 19,320. Accumulated depreciation at the beginning of the year was 138,000. And depreciation for the current year, it was 19,320. It takes it to 157,320. Now, check what I'm going to do now. Because I'm just focusing on that, I'm just going to go to my tangible asset node, which is this node here. And I'm going to go to disposals. They wrote disposals only. Don't be fooled. It must be disposals at carrying value. It must be disposals at carrying value. And that's where you need to go back. I explained earlier on what carrying value is. What is carrying value? Oh, there's this series I used to love. I hope season 2 is coming. They call it Savage Beauty. Carrying value is savage. What's basically after everything has been savage, what we left with, that value that we left with, that we can still use, that allows us to use this asset to generate more income. That's what carrying value is. Now, when we calculate carrying value of this asset, it will be cost price of this asset minus accumulated depreciation of this asset, but it must be accumulated depreciation at the date we stopped using that asset. When did we stop using this equipment? On the 31st of January 2022. So we can't use 138 as accumulated depreciation. We need to use that 157,320. Am I right? Is it 157,320? That one, the one that we calculated. So you're going to take the cost price, which was 460, and minus the accumulated depreciation at the date we stopped using the asset. And that'll give us the carrying value at that date. And the carrying value at that date will be 302,680. Put it in brackets because we got rid of this asset. We don't have it anymore. It's gone. We couldn't even sell it. That value that we were supposed to derive from it, it's gone. It's over. It's done. Finito. Pelile. Fedile. That's what it means. All right? And the depreciation. Here's a funny part. That depreciation of this asset, I still need to add it to the depreciation account. And you'll realize that if you're smart enough, you will notice that they do somehow cancel out. And they give you depreciation of 0 just on this asset that was disposed. But I don't want you to think that deep. Okay. For now, you just take that depreciation of this asset that we salvaged in a way. We didn't even salvage it. It was destroyed. You're going to put it as depreciation. This is only on one oven that was destroyed. Let's go to the next question. I saw it. The next question asked us to calculate the depreciation of the remaining equipment. That's where you need to go back to your timeline, guys. Make this your best friend. For how long did we depreciate the remaining equipment? Be my best friend. No, it doesn't say that. It doesn't say best friend. It says something else. Anyway, we used it actually for 12 months. The remaining were used for 12 months. The remaining equipment was used for 12 months. But guys, it doesn't mean that I have to violate this rule here, where I need the carrying value of the remaining equipment at the beginning of the year. But already, guys, I've dealt with the one that was destroyed. I first need to find the cost price of the remaining at the beginning of the year. And then I need to find the carrying value of the remaining at the beginning of the year. How do I find the cost price of the remaining at the beginning of the year and the accumulated depreciation of the remaining at the beginning of the year? When we talk about the beginning of the year, we're talking about the 1st of October, 2021. We were given the total cost price. How much was it? It was at the beginning of the year. How much was the total cost price at the beginning of the year? It was 1,740,000. And I said within. That's what you guys love saying. We are within. But you don't know what that means. Within means you are in there. Within that 1,740,000, there is the cost price of that equipment that was destroyed. We need to take it out. And when you take the total cost price and minus the cost price of the equipment that was destroyed, you will be left with the cost price of the equipment that we still have that was not destroyed. Okay, I don't know why I did it there. I was supposed to do it here. I hope that makes sense. Now we're done with cost price. Phew. Now let's go to accumulated depreciation. Accumulated depreciation at the beginning of the year was 651,000, remember? But inside that 651,000, remember, we are not on the 31st of January. We are on the 1st of October. Don't be confused here. Okay, on the 1st of October, the total accumulated depreciation was 651,000. But on that date, the accumulated depreciation of the equipment that was destroyed was 138,000. You have to take the total accumulated depreciation and minus the accumulated depreciation of the equipment that was sold at the beginning of the year. In this case, it's equipment that was destroyed at the beginning of the year. So you will take that 651,000 minus 138,000. You will be left with 513,000, which is the accumulated depreciation of the remaining equipment. Now we have cost of the remaining, we have accumulated depreciation of the remaining at the beginning of the year. It's time to celebrate because now we're going to go back to this point here that I highlighted right there. This one here, this one. You see this one, this one, this one. Remember to always calculate the carrying value at the beginning of the year of the asset being depreciated. Which asset are we depreciating now? We are depreciating the asset that was not destroyed. Someone can say, oh, but what about the new? Guys, know that the cost price was at the beginning of the year. The new was not included. It was not within yet. It's still new. Just like you are not within varsity yet. Okay? You're going to be within varsity once you pass this accounting and you get to varsity. Then you're within. But you're not included yet. We good. So this new equipment was not included in there. All right. I'm going to calculate the carrying value now, which is that 1.2 million 80, 1.28 million minus 513,000, which is the accumulated depreciation. Now I'm left with the carrying value of the remaining. It's your choice. You can take that 1,280,000 and multiply by the depreciation rate. But the thing is, we are not depreciating using the cost method. We're using the diminution balance method. So I have to take the carrying value of the remaining multiplied by 18%. But how long did I use the remaining equipment? I use it for 12 months. So depreciation for 12 months on that remaining equipment will be 138,016. Done. Now, what do I do with that 138,060? I am going to go to my tangible asset note and include it under depreciation. It's part of depreciation for the current year. We have depreciation of the salvaged or destroyed and depreciation of the remaining. We left with the depreciation of the new. And we don't know what the new is holding for us. We know that it was purchased on the 1st of February, but we don't know at what price. All right. We don't know at what price. If it was purchased on the 1st of February, let's count. It's February, March, April, May, June, July, August, September. That gives us 8 months. So we use it for 8 months. But now they didn't tell us what the cost price of this new equipment was. Cost price. So you're going to take cost price at the beginning of the year. How much was it? It was 740,000. And the cost price of the asset we sold, how much was it on the 31st of January 2022? It was 460,000. But the cost price at the end of the year was given to us, which was 1,780,000. All right. So I'm going to use the reverse method here. So I'm going to take 1,780,000 add 460,000 and then minus 1,740,000. It will give me 500,000. That is the cost price. You only use the cost price here because you are not given carrying values. You are only given the cost price. We good. Check out my videos on cash flow statement to learn more about this, and check my videos on depreciation as well. Now, I think that was the next question that asked us to calculate the cost price of equipment, the new equipment. So I took balance at the beginning of the year, which was 1,740,000. You add it, you put additions, you minus disposals, it should give you cost at the end of the year. Know that if you were working with carrying value, you're going to have carrying value at the beginning of the year, plus additions, which is a question mark, minus disposals at carrying value, minus depreciation, and then have carrying value at the end of the year, and then work backwards to calculate additions. But here we were given the cost, we just work with costs. We good. Use the reverse operation to get additions, and this is your reverse operation. Add what you subtracted, subtract what you added. It'll give you 500,000. That's how you would calculate it, or you just use what I used earlier on. Timeline never fails. So the cost of this new equipment was 500,000. But someone can say, yeah, but when we depreciate this new equipment, oh, before I even get there, I'm going to take that 500,000 and put it under my tangible assets. As 500,000, it will be additions at cost. But then how do we depreciate it? Oh, it is cost minus accumulated depreciation. But how much is the accumulated depreciation of this new equipment? It's 0. So the carrying value at the beginning of the year, it wasn't there. So we only started having it on the 1st of February. So on the 1st of February, the carrying value was the cost price, which is 500,000. Times it by 18%, times it by 8 over 12, because we used it only for 8 months. It is the one that I highlighted in green here. We've had it only for 8 months, so we've only used it for 8 months. I'm going to take the depreciation, take it to tangible assets, and put it and add it to my current depreciation. So my depreciation in total will be 217,380. So you add 19,320 with 138,060, add it with 60,000, it will give you 217,380. And that's it. Oh, this part here. Accumulated depreciation at the end of the year. How do we calculate it? Together with cost, they're pretty much the same. It's just that cost works with cost, accumulated depreciation works with depreciation. You use this short formula. Oh, I calculated carrying value at the beginning of the year, which was 1,740,000 minus 651,000. It'll give you that 1,089,000. And this is what you use to calculate accumulated depreciation at the end of the year. You take accumulated depreciation balance at the beginning of the year, which was that 651,000. You minus accumulated depreciation of the assets sold, which was 157,330. And then you add current year depreciation, which is that 217,380, right? So you take opening balance, which was given to you already, 651,000, you minus accumulated depreciation of the asset that was destroyed, which is 157,320. I hope I said it right the last time. And then we're gonna add the depreciation. So depreciation increases accumulated depreciation. Guys, by now you should get it, okay? Depreciation, a bin is accumulated depreciation. In that bin, you throw garbage, which is depreciation. So the more you depreciate it, the higher the accumulated depreciation. But on that day where garbage has to go out, where your asset is now destroyed like this, you have to take all the accumulated depreciation of that asset up to the day it was destroyed. All of it must be subtracted from accumulated depreciation. Guys, this is key, the one that Future was looking for. You'll end up having 711,000 and 60,000. I mean, and 60, did I say 60,000? Oh my word. Listen carefully. Yeah, that'll be 711,060. All right, and that'll be it. Hope you enjoyed the lesson. Hope it helped. Thank you for watching. Please like, share on all your social medias, subscribe, tell your classmates that you've got this cool YouTube channel. Thank you for watching again. Twani, thank you. I really appreciate it. Khotso.